If you asked me 20 years ago which commercial property sector would deliver the strongest returns in the next decade, I probably would have said office, prime CBD office. That was a safe bet, the blue chip of commercial property. And you know what? I would have been wrong. The last decade belonged to industrial and logistics, properties that most investors would not have looked at twice in 2005. Warehouses on suburban fringe, distribution centres near railway lines outperformed premium office towers by a significant margin. I remember it wasn't the flavour of the month in those times. Looking back around the Botany, Matraville area, a strong industrial area now, there was acres of industrial land for sale for months, if not years, no one willing to touch it. Now it's prime real estate. Very sought after at the moment. The lesson in commercial property, sector selector is just as important as a property selection. You can buy the best building in the wrong sector and underperform, or you can buy a solid asset in the right sector and perform dramatically. Let's talk about which sectors deserve your attention. Start with a clear standout, industrial and logistics. This sector has been a star performer of Australian commercial property for the past 5 years, and I believe it's still significant runaway ahead. Here's why. The structural drivers behind industrial demand haven't changed. If anything, they've intensified. E-commerce continues to grow, requiring more distribution and last-minute delivery space. Supply chains are being reshaped, with business bringing inventory closer to population centres. And the development pipeline is constrained because industrial zone land in key location is genuinely running out. For example, Sydney's western corridors, vacancy rates for prime industrial space are below 1%. Melbourne's southeast is simply tight. When vacancy is low and demand keeps growing, you get sustained rental growth. We're seeing 5 to 8% rental increases in prime industrial markets. And I don't see that slowing in the short term, obviously initially fueled by the pandemic and the people wanting to buy things from home and retail closing down, etc. But this is continuing on in our current market. Now the entry price has gone up. That's a trade-off. Industrial yields have compressed significantly from where they were 5 years ago. They are a prime investment now. People wouldn't touch them 10 years ago. But rental growth story more than compensates than that compression. If you're looking for consistent, reliable income growth with strong tenant demand, industrial remains the sector to beat at the moment. Second sector, office. Now, this is where it gets interesting, and where I think a lot of investors are getting it wrong. The narrative you hear in the media is that office is dead. Work from home has killed the office, which started way back in the pandemic years. Nobody's coming back. And look, that narrative has some truth in 2021 and 22. But in 2026, the data is painting a much more nuanced picture. What we're actually seeing is a flight to quality. Premium A-grade office space, buildings in well-connected locations are performing strongly. Tenants are consolidating in better places. They may be taking slightly less square meters, but they're actually paying more per square meter for better quality, better amenity, better locations. The real opportunity, I've been saying for this for 2 years, is suburban office markets. As hybrid work becomes permanent, many businesses are realising they don't need CBD headquarters. What they need is quality suburban space close to where their employers live, like Parramatta, North Sydney, Chatswood, Macquarie Park, And similar markets across the capitals are seeing genuine demand growth. My recommendation, don't write them off entirely, but be very selective. Focus on quality assets in locations with strong transport connections and amenity. And don't ignore suburban office space. It could be one of the best value plays of this cycle. Next one is neighbourhood retail. Here's a selection most investors have given up on: retail. And I understand why. The death of retail narrative has been running for a decade. Like most narratives, it oversimplifies reality. The truth is, large format discretionary retail, big shopping centres anchored by department stores, is still facing challenges. But neighbourhood retail centres, the ones anchored by Woolworths, Coles and Aldi, with essential services like pharmacies, medical centres and food outlets, are thriving. Have a look around. Go to your local shopping centre. How many vacancies are around? Probably not many. The pandemic permanently changed shopping habits in favour of local convenience-based retail. People discovered they could get almost everything they needed within a 10-minute drive. And that behaviour shift has struck. Neighbourhood centres with the right tenant mix are posting occupancy rates above 95% and delivering reliable returns. What I love about neighbourhood retail from the investor perspective is the defensive quality of the income. Essential retail tenants tend to have long leases, strong confidence at a relative predictable turnover. In an uncertain economic environment, that resilience is incredibly valuable. Now, let me talk about a sector that barely existed in commercial property and very new to many people. Some people don't even know it exists at the moment. That's data centers. Barely existed in property portfolios 10 years ago, but now is one of the fastest growing assets globally. Data centers. You're reading about them all the time now. Australia's digital economy is expanding rapidly, driven by global computing adoption, artificial intelligence and workloads. And the exponential growth of data, streaming service you watch, all requires physical data infrastructure. The major cloud providers, AWS, Microsoft Azure, Google Cloud, are all expanding their Australian data centre footprints. Domestic operators are building as fast as they can, and demand is outstripping supply, particularly for powered shell facilities in key locations like Western Sydney, Melbourne's West, and parts of regional New South Wales. Data centres are specialised asset class. You need to understand power structure, cooling systems, and connectivity requirements. But for investors willing to do the homework, or those looking at data centres, REITs, as a more accessible entry point. This sector offers some of the strongest long-term growth fundamentals of all commercial property. The final sector I want to highlight is what the industry calls the living sector. Build to rent, student accommodation, co-living, boarding house developments. They've had a bit of stigma in the past, especially boarding houses, place of drunks and drug addicts and criminals staying there. That has changed. When a DA comes up, the residents are in uproar. We don't want these sort of people in our neighbourhood. But if you look closely, you can't tell the difference in a lot of cases. They're fairly good quality properties. And student accommodation is still growing. There is a serious shortage of accommodation. And obviously, the other one is the cost of buying a house or unit is very expensive, out of reach for most people. And build to rent is becoming more and more fashionable and in heavy demand. Australia has a well-documented housing undersupply problem. The National Housing Accord target of 1.2 million new homes by 20 is widely acknowledged to be unachievable at current construction rates. That undersupply is driving rental growth across every residential category and creating enormous demand for alternative housing models. the rising construction costs are not making things easier. Build to rent, large-scale purpose-built rental developments, is finally gaining traction in Australia after years of lagging behind the US, UK and European markets. Government incentives, tax concessions and strong investor interest are accelerating the development. Student accommodation is another strong play, particularly in cities with major university precincts. International student numbers have recovered strongly post-pandemic, and purpose-built student accommodation commands significant rental premiums over general housing and boarding houses, a topic I covered extensively on this channel, continue to offer attractive yields for investors who understand the regulatory framework and management requirements. I have a lot of more information on that on my website, thesis.properties.com. There you have it, 5 sectors, each with distinct risk return profiles and growth drivers. The question is, how do you allocate? My recommendation from watching investors succeed and fail across 4 decades is to resist temptation to chase a single sector. Diversification across sectors is just as important as diversification across locations. The best commercial property portfolios I've seen combine the growth potential of industrial with the income stability of neighbourhood retail and emerging upside of data centres and living sector assets. Working with an experienced advisor who understands the nuances of each sector, who's actually transacted in these markets and seen cycles come and go, can help you build a sector allocation strategy that matches your risk tolerance, income requirements, and growth objectives. If you found this useful, do me a favour and hit subscribe. And if you'd like to discuss how this sector trends apply to your specific situation, visit thesis.properties.com and take a free property investment readiness test. I'll see you in the next video.